Hi, I'm Amy, Head of Learning and Development and Support at Trade. I am the most excited, I think, that I have been for a session in a really long time. And the reason for that is that for those who do know this, and for those who don't know this, obviously I've been in credit for the last 6 years. But before I worked in credit, I actually worked in VAT recovery for 4 years before that. So finally, at one point in time, my two different careers and knowledge bases have come together for me to be able to give this session, to which I am really excited about. So I am not a qualified tax practitioner, but I did work in international VAT recovery, and so I am excited to be able to give you this session as well. So let's jump right into what we're going to be discussing today. So first and foremost, this is just a little bit about what we're going to be covering and how we're going to be moving across throughout the time period, giving us a little bit of a timeline. Obviously, there's always room for you to ask questions. So by all means, raise your hand. We'll unmute you or pop something for us into the chat. And Martin and Neil will pick that up while I am talking, and or I am really great at multitasking. So I may be able to see it then as well. So let's move on from there to see what we're going to be talking about and jump into the very first slide so as not to waste time. And this is, we're talking about domestic VAT. So domestic VAT meaning VAT that is for your own country. This is when, so this is what actually really matters, because most of us are based in South Africa, and we hear a lot about, tax, and then we sort of switch off and thinking that's a finance problem and it's not really our problem here in credit. But that's not entirely true at all. So what is domestic VAT? As most of you may not have this down, what is the standard rate of domestic VAT? What's the output of the tax? What's the input? And so those are what we're going to be looking at now. So the moment that your customer is based in another country, there are 3 separate things that shift all at once. Okay, and here's the trap. Most credit teams only ever notice one of them, which is usually the VAT rate question, and it completely missed the other 2 as well. So the first one is obviously VAT, the next one being withholding tax, and the next one is around default and write-offs when it comes to VAT as well. And I think this was actually raised as a question in one of our previous sessions that we had 2 weeks ago. So I'm really glad we're covering it now. So the first one, which is VAT, let me add my little pointy here, which is VAT. So the VAT treatment itself does change. So an export sale can qualify for what's called a zero VAT rating, okay, meaning that VAT is charged at a 0%. So in South Africa, the VAT rate is 15%. And so certain foods, like, for example, bread, are 0 rated VAT items. And so you'll see that we're also able to have a 0 VAT rating when it comes to certain exports. And that sounds like great news, because, then we don't have to worry about having to claim this back. It's automatic, it's 0, and it gets put on your invoice that they are a 0 rated VAT product. The second one we're talking about is withholding tax. So withholding tax, which is completely different tax from your normal VAT, it doesn't care about what you did with your VAT. It can only apply on its own. So it's totally separate to that of your actual VAT. Okay. And certain types of cross-border payments are affected by withholding tax. And depending on what the deal is, either you or your customer can be the one liable for that withholding tax. So you may have to charge the tax, then you may have to give a certificate to your customer for them to claim that withholding tax back, or to prove that that withholding tax needs to be claimed by you. So obviously it can't be claimed by both parties, and both parties need to say who's the person who's liable for that withholding tax as well. So the third one that we have, and this one is the really one that catches most of the people out, is what happens on the VAT side when a foreign customer doesn't pay, and then you have to write them off. So it does not work like normal domestic bad debt, like you would normally write it off. And the mechanics are a little bit different, and if you treat them the same way, you can end up with a VAT position that doesn't really match reality, where you've either overpaid in your VAT or you've tried to double claim, and then you can then get into trouble with the tax man, and it will trigger them to do an audit on your business. Okay, so put these three things together, and you can see why this is, really important. To get one of them wrong, it can then leave you in a position sitting with a credit loss, which is, of course, what we're here to aim to avoid, and what Rachel is trying to help you to mitigate. Okay, so we're making sure that you're sitting in the tax exposure. Also, when you're collecting your funds, it's important to know whether or not your invoice includes VAT, includes tax, if there's withholding tax, so we can then manage our cash flow correctly as well. So what is zero rating on export sales? Okay, so these are the mechanics of it, because this is the one that can trip you up a little bit more in the credit team space, more than anything else as a whole. So the basic rule is that if goods are physically exported out of South Africa, that the sale can be zero rated for VAT purposes. Okay, so zero rated means that VAT is charged, but it's at a 0%. So you don't not charge it. You do put it on your invoice, but you state that it is at 0%. Okay, rather than the standard VAT rate, which you can apply on a domestic sale, such as our 15%. I remember when the good old days when it was 14%. Now that sounds a little bit straightforward to you, and it sounds like it's really super easy, but there is a catch, and I want you to really understand that zero rating is a relief that you have to earn. You can't just start to zero rate your invoices without the correct information. So it's not something that you can just assume that because you export, therefore you're allowed to zero rate your invoices. So there are two ways in order for you to get to apply for this in your practice. The first is called a direct export. This is where your business arranges and pays for the transport of the goods out of the country. Okay, the second one is an indirect export, where the foreign customer or the appointed agent, so it could be like a logistics company, they themselves are the ones who then take on the VAT. So you charge zero rating, and the transport company is the company that will charge the VAT, and the transport company is the person that will also put that VAT in their claim, not you. Okay, so that's very important, because you can't have multiple people charging the same invoice for VAT and claiming that back in their returns. Okay, so very important. If you zero rate, then the transport company exporting it out of the country will be the person that is therefore liable to claim that VAT back on their return. Okay, so there's no, you can then decide which one it's going to be, but you need to be you need to decide between yourself and your export company, or if you are the export company, how that will land with you. Okay, so why does this land on your desk in the first place anyway, and not just in the finance team? Because zero rating isn't automatic. Your system will automatically put a 15% that portion on an invoice. So that usually comes from us in the credit teams, where we are creating those invoices. So we need to understand which VAT rate gets used on which invoice or which customer. Okay, so if the proof is not obtained and also kept on file, then SARS can come back and say, they can deny that there was a VAT rating, and then you'll be liable for the VAT that was outstanding. So they'll say, oh no, you owe us that 15%, which you actually didn't collect from your customer. So therefore it would come out of your pocket. So that's very important to understand what the penalties are as well for incorrectly charging the zero rated VAT, because there is VAT on the invoice. It's just a matter of who's the person responsible to pay it and to claim it. Okay, so in effect, it is a credit decision, and the consequences do get baked into our space, because we are the ones generating those invoices, and we are also the ones generating and collecting on those invoices as well. I don't see any questions on what zero rating is, and who is the person responsible for that. So just on that, I do want to say that even when you are trading internationally, whether it's overseas in Europe, I will see that Sharif does have a question for me. Thank you, Neil. So when you are trading with different countries, you do need to decide what is going to be the process, because you need to then claim your own VAT back, and you need to ensure that you are the person that is liable to claim that VAT back as well. So it may not sit with you. So Sharif says, so the law does not apply to where the transfer ownership takes place. Yes, so absolutely, Sharif, there's something called reciprocity.
Martin, did you also lose Amy?
Yes, I did. She's
Apology,
there we go. You're back. We lost you
for
at
a second? Yes,
reciprocity,
sorry.
Ames.
Okay, so there's something called reciprocity, and this is the relationship that your country has with other countries. So it's the rules that are set out to say that if we trade, we have an agreement with VAT and tax with that country, and we're allowed to claim certain things back. Sometimes it's not everything. So for example, tax on fuel. So some countries allow you, it's called MOT, and you can collect your, if you fly from Canada to Switzerland, you can claim that money back. But if you fly from Canada to India, you cannot claim that back. So there's something called reciprocity, and there's different directives as well, which I'll go into in terms of where you are based. So there's something called 13th directive, there's something called 8th directive, and there's something called 6th directive. 6th directive being domestic VAT, which means you have a registration in that country, even if you're not based in that country. 13th directive is if you are based outside of the EU and you want to claim into the EU, and then 8th directive is EU to EU. These are the different directives, but we're going to get into that in a second, and I'm going to hopefully answer your question in full. But yes, the law does not the law does apply, and it does say with where you can claim. So if you are unable to claim from that country, and or if you are not the transport company, so some countries say you have to charge this person VAT and you'll claim it back in your local VAT return, and because we don't have reciprocity as a country, and therefore you can't then zero down the line. Sorry, my husband is switching over my internet connection here and driving me.
Don't worry, it's still around.
Sorry.
We lost him again, Amy. I think you should just repeat that last
I know
part.
that should be the very last time. Sorry, we're switching over from Eskom to solar. For those who were online last week, I did not have any electricity on our third phase, and we still do not have electricity on our third phase. But the exciting thing is we do have sun today, so I can see that my husband is switching us over. Apologies for that. But hopefully it should be quite stable now going forward. Okay, so let's look at the documentation that SARS wants to see. So I'm hoping that, Sharif, I did answer a little bit of your question and that you heard the entire portion that I was mentioning, and it was just between the slides, but I will get to the answer with regards to the law. Okay, cool. So what documentation do we actually need? What does it look like in practice? So let's walk through what this looks like, and through the file that you're going to need to exist with every single export shipment that you extend on a credit. So you would need the export invoice itself, and this does need to be an original. Okay, matching the actual shipped document, so the actual shipping information. So you've got the invoice, and then you've got what's referred to like a delivery note to say that this is actually what was in the package. Okay, and that's not like a quoted document, it's actually what was shipped. You need the proof of the physical export. Information, sometimes it's called a bill of entry. Plus you need your transport documentation and the
Amy is gone. Neil?
Yeah, gone. I think, shame that switchover is probably just causing her a little bit of trouble. Just give her a minute or two to come back. Everyone can stretch their legs.
Okay.
Welcome
Sorry
back.
about that. Yeah. Okay. So hopefully you heard the last bit, which was around your customer clearance, and sometimes it's called a bill of entry, plus the documentation that you're going to. that you're going to need, which is an export company or a transport company will need to be registered to export products, and they would then be given an export number as well, which would then also be placed on your invoice as well. So if you are that transport company, then of course you would put it there. And if you use an external company, then you would then use their export code as well. Okay, so these are the things you're going to need. And so if you are, if you have a bill, so if it's going by land or it's going by sea, so you would need a landing bill, a lading bill. You would also need an airway bill if it went via an aircraft, or if it went via sea. If it went via road, then there's something called a road manifest, and that's something that your truck would then need. And every time the goods actually crossed out of South Africa, and it's not someone that like loaded onto a truck outside of South Africa, it means that it was loaded in South Africa and it was shipped over a border. You would need the proof of payment received from the foreign customer in whatever currency it was that they had, because this ties the whole transaction together to say that we've invoiced you, we've actually created the way bill, we've actually given it to the transport company, and this is the transport company's export code, and this is the actual proof of payment that the customer gave us. And these are all the things that you need to show to say, I charged you A, I was paid B, and these are then matching together. And these all would need to be the original, and they would need to then be submitted with your tax return. So even if it is a null or zero rated invoice, you would still need to file it in your tax return as well. So it's important to make sure that you don't leave it out, because your revenue will then not match what you then submitted to SARS. So you make sure that even though it's zero rated, that you are submitting that with your local tax return as well. Okay, so and that means that the whole transaction will need to go together. So note, this is not purely on cash sales. So I see Sharif asked, is this purely on cash sales? No, even if you trade on credit, then you would need to then file it in your next month's return. So you won't be able to pay it now because obviously the customer hasn't paid for it yet. So if you trade on credit, then you would need to wait for that remittance advice before you file your annual return. There is a grace period. You don't have to file everything that month that you had from the month before in your domestic VAT. You would need to be able to do it in your next session. You're actually allowed to claim 5 years back. So you have a grace period of 5 years in your domestic VAT. It's not something I would recommend. It can be very intensive and again can trigger an audit, but you can file it in your following month. So when the person does pay, or if they have 60 days, then it would be in the 2-month period after that. So cash sales will be in the month that it is received, and credit will be in the month where the money is received. Okay. So there is a practical point here. So for you as credit people and for me as a credit person and VAT person, and this is the bit I really want to land on, is that this cannot be something that finances chases after the goods have already left the building. So that's also important, is to make sure that before they even leave you, that you know that this is an export customer, that you know that these are the documents that you're going to need, and you know how you're going to bill this customer and who's the person responsible for claiming that VAT back. So whether or not you need to charge for it or not charge for it. And that all needs to happen, of course, before the person actually you put it in a box and let it leave. So that's often where the gap comes in, is that we've shipped everything, we've invoiced them with tax, but it turns out we weren't supposed to. It was supposed to be zero rated, and now we're having to redo this whole process all over again, and would have to then send documentation to the VAT supplier to say that we're actually not liable to claim this VAT because it's not our VAT, and. So it can get quite messy if we don't do it right the very first time. So this matters because this exact list of what we're seeing over here can vary depending on what goods you export, what route you take, what country they're going to. So confirm the specifics with your own finance team first to make sure that they're also aware of it. It does live with them, and again should also live in your credit policy on how this will work in your business. Okay, so rather than treating it what's going on, it actually needs to be gospel in your actual teams, and this is where my job here is to make sure that you know the questions that you need to be asking the finance team, not necessarily only what you're needing to be doing, but you need to liaise with them and say, what are the rules in this particular space? Okay, so is your customer really foreign? And I was going to make a joke, but I'll keep it to myself. So right now, let's talk about something that can be a little bit confusing. And this again comes down to the question. So what is considered a foreign customer? So always it means that obviously we're exporting something to another country, but it doesn't automatically apply because the customer may have two different options. So picture this, you have two different customers, both headquarters are based outside of South Africa. The first one is genuinely foreign, meaning that there's no VAT registration in your country. So there's no branch, there's no local staff, there is nothing. There is a customer profile where everything that we've covered in the first few slides was built for. And that's what we're talking about. It's the customer that really has no footprint in South Africa, and it is considered an export sale with a 0 rating that is potentially available with the right documentation trail. The second customer is also foreign owned, but they actually registered in South Africa. So they have a foreign VAT registration in South Africa, and you need to ask these questions to say, do you have this? Because they may want to, and it's very common for businesses to VAT register in a foreign country so that they claim the VAT back as a 6th directive and not as an 8th or 13th directive because they have different rules that apply to them. So it's important to say, yes, you may be based outside of South Africa, but do you have a South African registration? Which can happen. Okay, so we need to make sure that we're asking that question as well. They may not have a physical branch in South Africa. They may not even have physical people in South Africa, but they do have a VAT or domestic VAT registration in South Africa, in which case they would then be liable to pay that 15% VAT, and we would need to charge them that 15% VAT, and they would then put that back in their local VAT recovery return. Does that make sense to everyone? Okay. So both of them based outside of South Africa, but one has no footprint, no registration, and the other one does. Okay, so here's a practical takeaway that you can look at. So at onboarding, don't just ask which country is your customer in, ask whether they're VAT registered here or trading through any other local entity here as well. And that's one question that we can definitely get right at the onboarding side. Okay, so one of those avoiding the issue at the end of the process. So this comes to that fun word that I was talking about earlier, which is the word called reciprocity. And I want to be upfront about this one. It is slightly different for everything else that we've covered because this is not really about the sale that you're making. It's more about the costs your own business incurs while doing business that is cross-border. So if you want to picture it like this, the business sends a rep to a trade show, for example, in another country and pays the local supplier there for something related to the deal. For example, you send an employee to London for a conference and the conference is obviously business related. This employee is going to incur costs such as hotel spend, food, the actual conference itself. These are all things that incur tax or VAT in foreign countries, okay? And so you can then claim some of these things back, as well as if you, I remember when I was working in VAT recovery, one of our customers was based in the US, and they used to purchase massive printing machines in the UK, and they would then ship those, these huge machines to the US. And if they broke, they would ship them back to the UK, have them fixed, and then ship them back to the US. Huge, massive printing machines. And I remember that each time they did this, every time that they imported, they would then have to pay the import duties and the VAT on those import duties, which was actually claimable back. So it's not just necessarily your hotel stay or, you know, things that you may purchase. There's a whole wider variety of things that you want to think about when you're thinking about VAT, as well as the product that you are then shipping. So that's important for you to understand that everything accumulates in terms of where you are actually liable to pay VAT and where you're actually able to claim that VAT back. So VAT gets charged on everything, and so you know anything that is domestically there. And the question is, can you get it back? Okay, so that's the first one, is can you get it back? And here's what reciprocity means in plain terms. A lot of countries will only refund VAT to a foreign business if that business's home country offers the same treatment in return. That's what reciprocity means. If you allow the people from my country to claim back from your country, I will allow you to claim back from my country. And if you think about what VAT does, VAT goes towards the running of a country. So when you put in petrol, it goes towards the building of the roads, it goes towards the repair. But if you don't live in that country, you are not obligated to pay towards it. That's really what it's saying. Okay, so reciprocity says we have an agreement between our countries, and these are, some countries say, yes, we have reciprocity, you can claim A and B, but you can't claim C. But if you go to another country, they'll say, oh, you can have C, B, and F, but you can't have A. And so the rules are quite complex, which is why companies like VAT IT are so successful, is they learn all these different funky rules that happen around the world that allow you to do so. So that is what reciprocity means. Basically, you scratch my back and I'll scratch yours. And the part that really matters to us specifically in South Africa is that South Africa doesn't have a broad scheme of its own when it comes to refunding VAT to foreign businesses and services, which means that when other countries check whether or not they owe South Africa the same courtesy, quite often the answer is no. We do not have a huge reciprocity with other countries, unfortunately, even on the African continent. And so South African businesses can be turned down for a VAT refund abroad purely on the reciprocity grounds, even if the other boxes are ticked. So you need to ensure that you need to know what are the rules of that country as well. So if you are traveling for business, sometimes you can, and you can do certain things at the airport as well. So if you purchase a product, you can claim certain VAT back as an individual, but as a business, you may not be liable for the same thing. So what does it practically mean? That if VAT is paid and costs are incurred while doing business in other countries, it can end up being a straight unrecoverable cost, where you've paid the VAT and you cannot claim it back. So it's not sitting like some refund queue waiting for someone at the back to eventually come and give it back to you. It is gone. It is paid for. It is gone. And that is the end of the discussion. Okay, so that is what reciprocity is and how it works. And so, you know, on an honest level here, before we move on, is that reciprocity positions may vary from country to country, where South Africa may have reciprocity with one country, but they may not have reciprocity with another country, which also may vary in terms of how you want to use your business as well. To say, we would prefer to trade with a country like Namibia, where we do have reciprocity, versus a country like Zambia, and I'm not saying that we don't have reciprocity there. I'm just saying that you would choose not to then export to that country, or via another country to then repurpose, or you may want to also domestically register your company in that country as well. So it also allows you to then say, maybe as a South African entity, because we trade so often with this country, and because there's no reciprocity, it is in our best interest as a business to register for local VAT in that country. Okay, in which case the rules would then change as well, because then you are considered a VAT, a registered company in that country, and therefore you would then have domestic VAT in that country, not foreign VAT. Okay, so that is quite a lot of information. I don't see any questions, but I'm hoping I'm saying this as clear and as plain as possible. All good. Okay, so let's talk a little bit. All good. Okay, so let's close out the part of this session with some terminology, because if you deal with EU customers or EU costs, sooner or later, someone is going to say things like 8th directive or 13th directive in a meeting, and I want you to know what these things mean. And so this is me exposing you to that. So the first one, and the important piece of context before I even get into the details, is that these are European rules. And that is important, but all countries who trade with companies based outside of Europe and based within Europe would be subjective to these rules. So that is important. They are not South African law. but we are covering them because you'll bump into the terminology if you deal with any EU customers or EU-based costs, not because they govern anything about South African VAT position, but we also have taken on a bit of their terminology as well. Because it's been in place for so many years, we still call our domestic VAT Sixth Directive, even though we are South African. And so the Sixth Directive that we're talking about here is the original piece of the EU legislation that goes back to like the 1970s. And it was first put there as the VAT rules when you know, across the EU, but obviously it also changed with Brexit. And this is one of the biggest things that happened with Brexit, that your directive then changed from Sixth Directive to Eighth Directive. And the way and things that you were able to claim had a huge portion of an effect on businesses. So a lot of people say like maybe they didn't really understand Brexit entirely. It was when certain countries exited the EU. And so VAT recovery changed as well for those countries as well. So it's a very historical way of looking at it, but really what we're looking at from a Sixth Directive means that you are part of the EU or you are claiming locally within your local VAT recovery. So if you're going to claim from SARS, you're South African, you claim SARS, that's considered a Sixth Directive. Okay. The Eighth Directive, this governs how businesses established outside of the EU, but are still within, you know, within the European side of things. So, for example, like Spain or Portugal, they may not be part of the EU, but they're within the European entity, and therefore they are considered a Sixth Directive claim. And again, there are different rules that apply with how you claim, when you claim as well, and how far back you can claim. So these are all different things that come with the different directives. For example, when we get to 13th Directive, you only have within a year to claim your tax back, whereas a Sixth Directive or an Eighth Directive, you may go 5 years back. To say that, you know, maybe we didn't claim VAT for a really long time, and it gives you that ability to do historical claiming. So that is important, especially if you didn't know. And as I said, there are certain things that you can claim back, which can lead to a huge amount of money. You know, like, for example, as I said, when you're talking about refueling an airplane, the VAT that is on the fuel costs is significantly massive. And or import and export of large goods, it can be significantly massive as well. And therefore, it is money that is paid that you actually didn't need to pay. That would significantly impact your cash flow. And so it's important to understand these different areas as well. So the Eighth Directive established in the EU countries that reclaim VAT paid in different EU countries, and the word EU to EU is where that Eighth Directive sits. So if you're a South African business, this one doesn't really help us really because we're not based in the EU, but it's good to understand it. Now, the one that does affect us is the 13th Directive, and this is the one that actually matters, you know, right now, because it governs how businesses based outside of the EU, like South Africa, and how these companies then reclaim VAT if it is paid to an EU country. So if you are exporting from South Africa and you're sending it to anyone within the EU, then how will that affect you? We are considered a 13th Directive. Okay. And as I said before, this is where reciprocity is very important, where we have that relationship with those countries to be able to claim back certain things. Okay. So that is something that we want to be sure of. And then a practical summary is that if you are or you have a customer that you're dealing with in the EU that have EU VAT, and you are not an EU business, in other words, you do not have a local registration in those countries, which is possible. It's not just within the African continent, it's anywhere in the world that you can locally register your business. Then you are always going to be asking around the 13th Directive claims. Okay. And so that is around the different directives that we're exposed to as a country. And it's not just South Africa, as I said. If you're a US country trading in the EU, you know, or if you're an Australian company and you're trading into the EU, then those are the different rules that apply. Okay, so now we want to talk about something called withholding tax. Okay, and this is covered on an export sale itself, plus local registrations, plus reciprocity. So all these things fall into withholding tax, and it's a completely different area to VAT. Okay, and so again, we're going to be using a bit of EU terminology in terms of the directives, but let's move completely in the different tax directive that sits alongside all of that of the VAT as well. So it can catch people out even more because it is less well known. And that's important, is withholding tax. This may even be the first time you've even heard about withholding tax. So I want you to park that for a moment and let's move on to withholding tax so that we can talk about your export sales where it was zero rated or not. From a VAT perspective, there's still an additional cost as well. So what triggers withholding tax? So not every invoice is liable for withholding tax. And so let's talk about what is it? Okay, so this is a tax that gets deducted at the source, meaning before the money even reaches the foreign party from certain payments made from someone outside of South Africa. Wherever it is making payment, they withhold a slice of it and pays that portion straight to the tax authority rather than it going through a normal invoice or invoice and pay transaction process. Okay, and if someone is liable for withholding tax, you may have charged them and now they're coming to you to claim that tax back. Okay, so they need to be upfront whether or not it is going to trigger withholding tax so that you can take it into consideration when you bill them, because otherwise you're going to be, if your margins are very low and you weren't expecting withholding tax, then it can put you into a negative process. Okay. So where does this actually show up in the credit context? So a few common places would be cross-border interest. So if you're a financing deal, or if a foreign lender is funding a credit line, and because we are trading on credit, and you may then charge interest or penalties or royalties, these can all affect withholding tax. Okay, so anywhere that you've got intellectual property licensing or franchising agreements, cross borders, these all fall into that scope. So cross-border service fees on certain payments and services rendered by a foreign person or an entity. And if the dividends to a foreign shareholder as well is paid, then that can also trigger withholding tax. So it becomes relevant in your cross-border credit exposure that sits inside a group of finance within the financing structure, and it's not necessarily straightforward and seen within the credit side. But as I said, when you're looking at credit limits, when you're looking at billing, these should all be known to say whether or not you're going to be liable for withholding tax, because you would need to take that into consideration, that someone is going to come and claim that withholding tax back from you. Okay, so I really want you to walk away with this type of information to say whether withholding tax applies and what rate it applies with can be reduced or removed altogether by something called a double taxation agreement, so, or a DTA. I know we don't like acronyms, but that is what it is called. And this is between South African customers and the country in which you are dealing with. So you would need to come together to do a double taxation agreement to make sure that if that company is going to pay their taxes, that you are not going to double bill them. Okay, and you also can't double claim. So it's deciding who's actually the liable party, because you are not obviously based in that country, and therefore you're technically not liable to pay withholding tax within that country. And so you want to come together and put together that double taxation agreement when you are exporting. Okay, so there is a relief that is important to know, that, and one way or another, to make sure that we know who's the person responsible, and or whether or not it needs to be paid, and or whether or not you should then deduct it from the beginning of the process as well, to say we're not going to charge you withholding tax because you're going to pay it in your own country. Okay, so that is important for you to know. And obviously there are different rates and different thresholds for different countries. So that's not for me to then give you those rates and those taxes. You would need to then reach out to your finance team to find out, we deal with these countries, what do we need to do on these invoices, and make sure that we don't mess that up, because we don't want to be liable for withholding tax when we weren't expecting it as well. Okay. So I would definitely recommend reaching out to like a tax specialist, and they can also put together that specific documentation, that double taxation agreement with you. So if you plan to do this, I would reach out to a tax specialist, and they would be able to guide you on that paperwork as well. So if you walk away with anything in this session, it should hopefully simply be, what is the questions that we need to be asking? Do we export to these countries? Have we taken into consideration if it would trigger withholding tax? And how do we as a business work with withholding tax? Do we have certain agreements in place? So then it comes down, and I know I've said this a few times, is who is actually liable. So after you receive, I see Sharif asked a question, after you receive the certificate for withholding tax, is there a standard duration for us to claim this tax? Yes, there is. So again, if it falls into the 6th directive, you have within 5 years to claim this tax. Obviously, that is not the best process to follow. You should be filing your tax return every single month, and it should fall into one of those claims. When you are doing your tax return, your annual tax return, it should be a part of that. As I said, you do have an option for later returns to say, like, maybe we forgot for whatever reason, or I'm hoping that you don't run your business that way, but it should be part of your annual tax return, and you will need all the documents that we've spoken about in order to actually prove that you're not trying to just take money from the government and or from a foreign government. So make sure that you've got the documentation. Okay. So we will get a little bit more into that as well. So first and foremost, who is liable to pay this and that's important as well, to say, like, maybe you're actually not liable, which is why you're able to zero rate or why you're able to deduct that amount from your invoices. It's important to know and to slow down here at this point and say, like, am I actually liable for the withholding tax or not? And most people's instinct is to assume that if it's foreign, then it's the customer's problem, right? Because I'm not registered there, it's not my problem. But because they're actually not the one receiving less than the full invoice amount, so if there's like a deduction on that invoice, then in most structures, it's actually the South African party making a payment who carries the legal obligation of that withholding tax, and therefore they have to pay it over to the tax authority, and it is not, and therefore you claim it back. Okay, so the person who pays and the person who claims is very important, okay, to say that you don't want a double claim when you don't have an agreement in place, because that means that you're claiming back from your government and they're claiming back from their government from the same invoice, which can be a huge problem. Okay, so we need to make sure who's going to pay it, and we need to agree that with our customer as well. Okay, so it does carry those legal obligations of the withholding tax, and we need to make sure that we align with the tax authorities and the rules that apply with it as well. So this is where it gets a bit expensive if it is missed as well. If tax should have been paid, should have been withheld, and it wasn't, the South African payer is then potentially, which is your business, can be held liable for the shortfall. So if you don't do it correctly, you are going to be liable for that shortfall in the currency of which that you are charging. And often sometimes there's penalties and interest on top of that for it being late as well. So the money's already gone to the foreign party, but at that point, it is not sitting in an account waiting to be corrected. So trying to claw back this information, this money from an offshore counterparty after the fact as well can be very difficult, and has a very different level of of things that you need to follow if you've incorrectly charged and or not charged withholding tax. Okay, so here is what I mean by this in a practical sense for you in the credit space. So most of the time, credit teams are focused on the money coming in and, are we going to get paid? Yes or no? In some cross-border relationships, your business is also the one paying money out to a foreign supplier, whether it could be, and this is obviously on your procurement side and not necessarily on the credit side, but even from a logistics perspective, if you're paying an international logistics company to transport your goods, therefore you also are going to be paying and or potentially liable for withholding tax. So it lives in your credit department, but it also lives in your procurement department, where you are a supplier as well as a debtor to someone else. Okay, so you want to make sure that you have a licensing partner, a tax practitioner, making sure that you are doing things correctly across your business. And we don't work in silos. We've mentioned this before. We don't work in silos. I know that often the credit team and the procurement team don't necessarily work the closest together, but it is important if you're going to trade and or purchase. So if you're importing or exporting goods globally and or cross-border within South Africa, that you're aligned as well. Okay, so making sure that you structure your deals correctly, that you get the supporting documentation, that, you know, and that's with the withholding tax conversation that needs to happen with the finance team before the first payment even, you know, before the first payment run even goes, okay, and before invoices are even set out. This is at the onboarding stage. Okay, so that when it comes to foreign debtors. So let's have a look at this. And I see it is taking me a little longer, so I apologize for that. So we've covered VAT on a sale. We've covered local registration. We've covered reciprocity. We've covered the directive terminology, and now withholding tax. So let's move on to the part of the session that I think matters most to us, especially when we are doing credit and we've been in credit for a while, because your instincts here are going to be your domestic, you know, your savior as well. And I know Martin says this all the time: know your customer, know, you know, become acquainted with them, their processes, their everything that you need to know to trade with them. So you already know what happens from a domestic bad debt side of things. So domestic meaning, you know, within South Africa, you've made the taxable supply, you've charged your VAT, your customer then does not pay. So we've done everything that we should have done, but now we get to a position where the customer has not paid, so they have defaulted on payment. So now we need to know, what do we do? And is there a mechanism to claim that VAT back that you've already paid to SARS? Because you would have done it, you know, 2-3 months ago when you were expecting to be paid. You would have paid for it in your sales, but you never actually got paid for it. And so that is, it's somewhat straightforward in terms of local, but let's talk about what it means in terms of cross-border. Okay, so domestic write-offs and cross-border write-offs on, you know, I've put them side by side for you so that you can see what they look like. On the domestic side of things, this is what you already know, hopefully, intuitively. The original sale was a standard rated VAT certificate, a VAT rating of 15%. It means that VAT was charged and the VAT was paid over to SARS at some point at the time of the sale, okay? When the customer does not pay you and you eventually write them off, there is a bad debt relief mechanism that you would then be able to claim back the VAT you already paid on the unpaid portion. Okay, so if they partially paid invoices and or if they didn't pay the invoice and you write it off, you can say to the tax man, I charged the customer for the VAT, I paid you for the VAT, but actually they never paid, and therefore I can claim this portion back from you. Okay, so that is something that you would need to know. And again, comes with documentation and timing. And so that is what we're looking for on a local side. Now, on the flip side, the cross-border side, remember that we said earlier about zero rating. So a large portion of our export sales are they likely went out with zero rated VAT. Okay. I see Renee said, how long is the period you have to claim that VAT back? So again, Renee, if it is local, so, you know, 6th directive or South Africa to South Africa, your general period of time is 5 years that you can claim back. Based on our reciprocity, it's usually 1 year for cross-border. So if you did charge somebody in a foreign country a foreign VAT value and you paid for that, you usually have within 1 year to claim it back. It is country specific. Some countries allow you to go further back, like 5 years or 3 years. I have seen countries go back 3 years, but it is important to understand the rules of that country. But generally speaking, the shortest period of time I've ever seen was Switzerland, and they gave a 6-month grace period on certain products. But again, we just need to double check. But generally, the standard is a year. I hope that answers that question. Okay, and sometimes the rules do change. They do like to mix it up a little bit, but that is the standard across what I have seen. Okay, so what you would need to do here, of course, if an invoice is zero rated for VAT, there's nothing for you to worry about because you didn't charge anyone, you didn't pay anyone. Okay, so you would then, nothing was ever handed over to SARS or to that entity overseas. So you wouldn't need to worry about it. But when a foreign customer does default, you need to ask yourself, what exactly is there to claim back? If there's no VAT was paid over, therefore nothing is available from a bad debt relief perspective. Obviously, there's still the value of the invoice that you would be writing off, and either that's going to come from your credit insurer or it's coming from your bad debt provision fund, but there would be no relief because of a VAT perspective. Okay, and what that means practically in terms of this is that if you write off a cross-border invoice, it is better to have it zero rated. It's a lot less admin on your side for you to be able to have it zero rated. Or obviously, if you sent something over and the VAT was charged to the transport company, then you would need to liaise with them as well from their side of things, because they would have claimed that VAT back. Okay, so obviously no VAT paid, no VAT claimed. What that means is you would need to then have a look and see what are the rules that you apply for. And if you did, so, if we don't get paid and there was no VAT relief either, because sometimes in countries they can say, sorry for you, we don't have reciprocity and therefore we will not give you that debt relief, or you would need to then claim it back from that local entity. If you did charge them VAT and you did pay it, you would then need to go ahead and have a look at it. Neil, yes.
Hi, Amzia. Thank you. Just one quick question. It's in the back of my mind. Does ECL take VAT, this VAT into account? So expected credit losses.
So when you're calculating your expected credit losses, it should take the consideration of the invoice without the VAT amount, if it's local, and if it's international, then again, if you're zero rating or you're not zero rating, because remember, when you charge someone VAT, that money's not yours. It belongs to SARS. So if I charge you 10 Rand and 5 Rand is going to VAT, I'm only going to be getting 5 Rand from you. I can almost consider that 5 Rand non-existent. So when we're doing our expected credit losses, we're not going to pay SARS for money that we didn't charge. Okay, so that's important for us to know.
Perfect. Thank you, Amy.
Okay. So bringing it together and putting it into a bit of a working example for you, because I know we do only have a few minutes left. So, just having a look at it. So picture this: a South African manufacturer sells equipment worth 1.2 million Rand to a customer that is based in Zambia on 60-day terms. It is a direct export. The manufacturer arranges and pays the shipping of that of those goods, and the sale is zero rated, providing the export documentation that we spoke about earlier that was obtained and kept on file, and the customer will pay 400,000 Rand, which then and then they go quiet. There's no further payment or response. There's nothing that you get from that customer. So basically they are absconding. It's the words that I want to use. So we would then trace the tax picture throughout that entire thing. We would look at the VAT on the original sale. If it was zero rated, we have no claim. If it wasn't zero rated, we would need to then claim it back from SARS under the area within SARS. It's not a regular claim back. It is under the relief side of things to say that we paid it, but we didn't claim it back. And therefore, you may be able to get that money back. So the outstanding balance of that point would maybe be around the 800,000 Rand mark. So you would only claim on the amount that was not paid. So if they didn't pay the whole invoice, you can claim back the VAT on the whole invoice. If they pay portionally, you're only going to get the portion that they didn't pay. Okay. So that's something that we would need to know. And this is just giving you some numbers and practical side of things of where it sits. So mistakes that can trigger some SARS queries, which of course we don't want to do, because that means that we start being investigated, and it does take a lot of time. Obviously, hopefully we've got nothing to hide, but it does take a lot of effort from your side. So missing or incomplete export forms. So we want to make sure that we don't have anything that we've missed out from a proof perspective. So not withholding the tax review before the payment. So we want to make sure that we didn't hold it back before we got payment. Very often withholding tax, they have to pay first and then you have to give them a credit. And you have to specify on your credit note that is withholding tax. And that is why that you are doing it. So you need to take that into consideration as well. Writing off your cross-border debt using the domestic logic. So we want to make sure that we don't use local logic for international trade. and treating your indirect export like it's a direct one. We want to make sure, we want to know who's liable, we want to know what companies we're using, we want to make sure that we have agreements in place and that those agreements cover the tax and VAT as well. So making sure that we cover all these different things so we don't trigger SARS queries. How would we do it? Is if we don't do all these things correctly and we submit a claim to SARS and that claim is actually not liable for us to be claiming because somebody else has claimed it, like for example, the transport company, we can't claim and they claim, we need to ensure who's the person responsible and who's the person liable to claim. So whoever pays, that's the person who's able to claim it. Okay, so there are some things that I want you to just have a look at before we run out of the door. Who's arranging and paying for the transport of those goods, what VAT treatment will apply to that sale, and if any payments in this relationship is flowing either way. So are we paying, are we receiving, are we a supplier or are we a debtor? Double taxation agreements in place, and then whether or not if this customer has defaulted and if we did charge that or if it was zero rated, then we would need to do that as well. And of course, that paper trail, everything needs to be original. So with local VAT returns, you can generally send an Excel spreadsheet with your proof, but it does allow them to come and say, I want to see the actual invoice for this particular claim. With international claiming, we do need the original documentation that would be submitted to the tax authority on that side of things. So make sure that you're keeping all these original documentation. So that is really where we are today. And of course, we will post the link for you to see this, the slideshow for you. And hopefully you did gain some valuable information from this session about how you should be treating withholding tax as well as with VAT on foreign entities, how that invoice affects us, and especially around our collections and making sure that we followed all the rules that are within our repository. So I see that we are at 1 minute past, and as usual, I'm always so grateful to you for joining us. I will pop up a poll for you, hopefully. I'm not sure if you're doing that, Neil, or if I'm doing that. I think it's just me. Neil, are you online? No. Okay.
Anyway, while you're busy popping up the poll,
yes.
I just want to say, first of all, a great presentation.
Thank you.
What you said is the one thing that I can take away is we must make sure who we engage with, which country, first of all, what is the relationship? Is it the relationship via somewhere else, via some company, or via a South African-based registration? We must do a lot of investigation, as you say, know your client. Know exactly, and there's two clients in this instance because it's a country and a client that you're dealing with. And the more information we can have and the more clarity we can have about how the tax is done and how the VAT is done and when can you withhold and when can't you withhold and when can you zero rate, all of that is all going to depend not on what you've said today because we could misinterpret, but on what those countries want. So it's important for us to do a thorough investigation before we start exporting to anybody.
Yes, absolutely, Martin, because it can, and especially if we are able to zero rate, it just means one less thing for us to have to worry about when or if someone does default on payment. So ask these questions, add it into your credit onboarding documentation, and make sure it's part of your credit policy. Align with finance to which countries you are exporting to and what the rules are with those countries as well. So I would definitely recommend that. And yeah, as usual, we are always so grateful to have you, and we will see you again next week, Thursday, for another exciting session. If you could just give us a vote on how we did today. I know it was a lot of information to jam pack into a session, but otherwise have a wonderful day and you're free to drop on off.
Thank you, Amy.
Thanks, Martin.
Very, very informative. Very good.
Thank you. I'll be here all week.
That withholding tax thing. Oh, I tell you, when I was working for Afrox, and we exported, of course, gas.
Join us every Thursday from 10 to 11.